Are you tired of seeing your investment gains eaten up by taxes? Imagine if you could keep more of your hard-earned money in your pocket. In this video, we'll reveal top tax tips for investors to make the most of capital gains rates. Stay tuned to maximize your profits and minimize your tax burden. Hi everyone, welcome back to our channel. Today we're diving into a crucial topic for investors: how to make the most of capital gains rates. Whether you're a seasoned investor or just starting out, these tips will help you save money and grow your wealth. Investing can be rewarding, but it also comes with its challenges, especially when it comes to taxes. Capital gains taxes can significantly reduce your investment returns if you're not careful. But don't worry, we've got you covered with some easy-to-follow tips to help you keep more of your gains. Short-term versus long-term capital gains. First, let's dive into the difference between short-term and long-term capital gains, which is crucial for any investor. When you sell an investment like stocks, bonds, or real estate, the profit you make is called a capital gain. But not all capital gains are taxed the same way. Short-term capital gains come from selling an investment held for 1 year or less. These gains are taxed at your ordinary income tax rate, which can be quite high depending on your tax bracket. Long-term capital gains are from selling an investment held for more than 1 year. These gains are taxed at lower rates, usually 0%, 15%, or 20%, depending on your overall income. Understanding the difference between these gains is important because it impacts your tax bill. Selling an investment after holding it for just a few months means paying a higher tax rate than if you had held it for over a year. Holding investments longer can save you money on taxes. If you buy stocks for $1,000 and sell them 6 months later for $1,500, your profit is $500. As a short-term gain, you'll pay taxes on that $500 at your regular income tax rate. If you wait and sell after a year, the $500 is a long-term gain, and you'll likely pay a lower tax rate. Plan your investments with these timeframes in mind. Holding investments for over a year can take advantage of lower long-term capital gains tax rates. This strategy helps make more informed decisions and keeps more of your profits. Knowing the difference between short-term and long-term capital gains can help you manage your investments better and minimize taxes. By holding your investments longer, you can benefit from lower tax rates and increase your returns. Take advantage of tax loss harvesting. This strategy can sound a bit complicated, but it's really quite simple and can save you a lot of money on taxes. Here's how it works. When you sell an investment that has lost value, you incur a loss. This loss can then be used to offset any gains you've made from other investments. For example, if you made a $10,000 profit from one investment but lost $5,000 on another, you can use that $5,000 loss to reduce your taxable gain, bringing it down to $5,000. This means you'll pay less tax because your overall gain is lower. But there's more. If your losses exceed your gains, you can use up to $3,000 of the excess loss to reduce other income, such as your salary. And if your losses are still greater, you can carry them forward to future years to offset gains down the line. One important rule to remember is the IRS wash sale rule. This rule says that if you sell an investment at a loss, you can't buy the same or a very similar investment within 30 days before or after the sale. If you do, the loss will be disallowed for tax purposes. So it's crucial to be mindful of this timing to ensure you benefit from the loss. Tax loss harvesting is particularly useful at the end of the year, as you review your portfolio and plan for taxes. It can help you make the most of your investments and reduce your tax bill. By carefully planning your sales and taking advantage of your losses, you can significantly lower the amount of tax you pay on your capital gains. This strategy requires some planning and attention to detail, but it can be a powerful tool to improve your overall investment returns. Utilize tax-deferred accounts. Another great tip is to use tax-deferred accounts like IRAs and 401ks. These accounts allow you to invest money without paying taxes on the gains right away. Instead, you pay taxes when you withdraw the money, usually in retirement. This can be a big advantage because your investments can grow without being reduced by taxes every year. Here's how it works. When you put money into a tax-deferred account, it can grow and earn interest, dividends, or capital gains. Normally, you would have to pay taxes on these earnings each year, but with tax-deferred accounts, you don't. This means you have more money working for you over time. which can lead to larger investment growth. For example, let's say you invest $5,000 in a regular investment account and it grows to $6,000 in 1 year. You would have to pay taxes on that $1,000 gain. But if you put that same $5,000 into a tax-deferred account, you don't pay any taxes on the $1,000 gain right away. This allows your full $6,000 to continue growing for the next year without being reduced by taxes. There are different types of tax-deferred accounts, like traditional IRAs, Roth IRAs, and 401ks. Each has its own rules and benefits. For example, with a traditional IRA or 401k, you get a tax deduction when you contribute, which lowers your taxable income for that year. With a Roth IRA, you don't get a tax deduction up front, but you can withdraw the money tax-free in retirement. To maximize the benefits, try to contribute as much as you can to these accounts each year. For 401ks, your employer might even match your contributions up to a certain amount, which is like getting free money for your retirement. Tax-deferred accounts are powerful tools that can help you grow your investments more efficiently by deferring taxes until you withdraw the money in retirement. By using these accounts, you can keep more of your investment gains and potentially have a larger nest egg when you retire. Unless you consider qualified opportunity zones. Now let's talk about qualified opportunity zones. These are special areas chosen by the government to encourage investment and development. The idea is to boost economic growth in these regions by offering tax benefits to investors. So, how does it work? If you invest in a qualified opportunity zone, you can defer paying taxes on your capital gains until the year 2026, or when you sell your investment, whichever comes first. This means you won't have to pay taxes on those gains right away, but that's not all. If you hold your investment in the qualified opportunity zone for at least 5 years, you can reduce the amount of capital gains taxes you owe by 10%. If you hold it for at least 7 years, you can reduce the amount by an additional 5%, making it a total of 15%. And there's an even bigger benefit. If you hold your investment for at least 10 years, you won't have to pay any capital gains taxes on the appreciation of your investment within the qualified opportunity zone. This can lead to significant tax savings and help your investment grow even more. Investing in these zones can be a smart move if you're looking to defer taxes and potentially reduce them over time. It's also a great way to support economic growth in areas that need it. Before you invest, make sure to research the specific qualified opportunity zones and understand the rules to maximize your benefits. So, now that you know these valuable tips, imagine the impact on your investment portfolio. By making strategic decisions about when and where to invest, you can significantly reduce your tax burden and keep more of your profits. This is a game changer for any investor. Understanding the difference between short-term and long-term gains, using tax loss harvesting, utilizing tax-deferred accounts, and considering investments in qualified opportunity zones can help you make the most of capital gains rates. These strategies are simple but effective in maximizing your returns and minimizing your taxes. Thank you for watching. If you found these tips helpful, please share this video with fellow investors. Don't forget to check out our other videos on our channel. Share your experiences and thoughts in the comments below, and make sure to like, share, and subscribe for more tips on growing your wealth.